Thank you everyone for this opportunity to speak to you today, and thank you, Bob, for a presentation that's extremely relevant to what I'm about to say. Today I'm presenting some research which my colleague Damien Oliver, who's also here at the back here, and I did late last year for the AEU. Now the research took place during a period of very significant change to funding models in vocational education and training, and at a time of significant media scrutiny over particular training providers. And in particular, questions were raised about the use of public funds to fund private training providers and the outcomes that were being achieved. So the research I'm presenting today looks at the scale and the flow of those public funds, the VET policy context which supports those flows, and where we might go to from here. Now, historically, of course, vocational education and training has been provided by publicly funded TAFEs. Since 2009, however, starting in Victoria, the states and territories have been rolling out a demand-driven entitlement-based funding model, whereby students are entitled to a subsidised training place at a training provider of their choice. And this has been the primary mechanism for opening access to for-profit private providers. The table here shows where we're at with the national rollout, with New South Wales commencing in January this year. The subsidy levels vary by state according to strategic skills needs, and fees and enrolments may be deregulated or capped. The research that I'm presenting today focuses on Victoria, which has seen the entitlement funding model mature since 2009. Now, the rationale behind the expansion of contestable funding is that greater competition amongst providers would improve student accessibility and affordability, improve the quality and transparency of training delivery, and improve confidence in the system of qualifications. The assumption is that poor quality training delivery will be competed away by better providers and well-informed students. But as we'll see today, this has emphatically not been the case. But before I go to the point of what's happening with public subsidies, I just wanted to go through the broader funding environment. The context for the rollout of the entitlement funding model has been one of declining overall funding for VET. The figure here shows changes in full-time student equivalent funding by sector nationally. Primary and secondary schools are shown in the blue and yellow, higher education in pink, and VET in the grey. It shows that since 1999, funding has fallen by about 25% in the VET sector, compared to significant expansion in the schools and overall level funding in higher education. This kind of large-scale decline certainly raises questions of what an appropriate price for a quality vocational education and training experience should be, and at what point that quality is forfeited. In this figure, data from the Productivity Commission shows funding per student hour by state, with the national average shown in grey here. It shows that funding nationally has fallen from around $16 to just over $12 per hour in the last 10 years, or around 22%. It's been prevalent across the states and has been particularly sharp in South Australia, where funding has dropped over 35%. A big part of these funding cuts has been taken out of state TAFE budgets, resulting in staff retrenchments, the closure of campuses, facilities, and a reduction in course offerings. And this has happened at the same time as the proliferation of for-profit training providers, which now number over 3,000 in Australia. In Victoria alone, following the rollout of the entitlement funding model, the number of for-profit providers more than doubled from just on 200 to over 420. Not surprisingly then, state funding to these for-profit providers has ballooned. What you can see here is total funding by state, with the Australian total here in pink and the other steep increase you can see there in blue being Victoria. Funding overall has increased from $477 million in 2008 to over $1.4 billion in 2012. As the chart here shows, the growth has been driven almost entirely by the Victorian experience. At the same time, the Commonwealth Government has also expanded income contingent loans via the VET Fee Help Scheme, available to students undertaking diploma and higher studies. Consequently, the number of approved VET fee help providers has also expanded from 37 to 194, and the value of loans has also grown in a similar way. Now, when HECS was introduced at universities, it followed deep analysis into the benefits received and the costs by degree graduates, and HECS fees were priced accordingly. It's quite alarming that the course fees for VET fee help studies are unregulated and have received no similar scrutiny at all. For VET students, there is concern about their capacity to repay these loans, given that their returns in the labour market are lower than their degree counterparts. And other analysis has shown that more than half of those aged 20 to 39 diploma holders earn less than the repayment threshold. As a consequence of this policy environment, there's been a huge surge in enrolments in Victoria over the last 6 years. The lines in this chart show growth in enrolments at the private providers in the red and at TAFEs in the grey. The yellow and blue columns show the share of enrolments at private providers and of TAFE. Since 2008, Victorian student enrolments have grown 39% annually at for-profit providers, and TAFE enrolments have shrunk. This has led to a fall in TAFE share of enrolments, falling from 90% down to 60%, as seen in the blue here. The Victorian government did not expect such a ballooning in enrolments and subsequent costs, and so to deal with the blowout, they made significant cuts to TAFE budgets in 2012, while the subsidy levels were also quickly adjusted. These cuts have affected TAFE's ability to provide a full suite of high-quality vocational education courses across all student groups, as well as maintain things like student services and their large campuses. Other research has shown that student access to VET for disadvantaged groups, such as those in regional areas, those from a non-English speaking background or with a disability, has lagged that of students in relative advantage in Victoria. The chart here shows that the vast majority of disadvantaged student groups still study at TAFE, and those are the red bars. The yellow bars show the proportion studying at private providers. Nor has the expansion in private providers been directed to skills shortage areas as intended. Private providers have dominated delivery in high-volume, low-cost courses such as management and financial services, and students in skills shortage areas are now even more likely to be studying at TAFE. The capacity of TAFE to continue servicing these areas is undermined by the current funding arrangements, which encourages the delivery of high-volume, low-cost courses. And as we'll see, undermining the sustainability of TAFE has not delivered the improvements in quality as promised by a more competitive provider market. So how have these for-profit providers been able to take advantage of the public subsidies? Analysis of documents publicly available from the ASX shows that the larger, more dominant enterprises have very sophisticated and complex business models. From a revenue point of view, they first market aggressively to students, often offering buy now, pay later deals with free iPads to sweeten the deal. The quote here in the yellow box is probably a bit small, is taken from Vocation, one of the largest providers, and I'll read it out. New students will be sourced by the direct business channel via 4 primary methods: direct marketing through traditional and online advertising, through professional brokers, Acquire Learning and Career Direct, through agencies such as Job Service Australia, Centrelink, Disability Peak Bodies and local employment networks, and through corporate client partnerships. Providers also grow their revenues by cross-selling between different business divisions and upselling students into courses which attract higher subsidies. At a cost level, they minimise their cost base by subcontracting out different parts of training delivery to other registered and often unregistered providers. This includes the development of course and curriculum content, teaching and assessment, and compliance and systems administration. These subcontractors are virtually invisible to the regulator, and it is impossible for students to know who is responsible for delivering which part of their educational experience. They can also reduce costs by delivering courses in significantly fewer hours, delivering courses online, and offering mainly courses which have low costs attached. And finally, they grow by merging and taking over smaller training providers. They seek out training providers with a student base in a different state or with different course offerings. They run different brands under one large company umbrella and often change or deregister the brand names for reasons which are difficult to trace. And throughout all of these investment documents, there's virtually no reference to how successfully their students have been able to find related employment or move into further studies. And I just quickly wanted to take you through two of the providers we looked more closely at. The first one was Vocation, which of course has received a lot of media coverage. The figure here, and the words aren't important, it just shows the ownership structure of Vocation. There are over a dozen registered and unregistered training brands across all industries, and there are very limited and mostly outdated audit reports on just a handful of these. Yet in Victoria alone, Vocation quadrupled its publicly funded student enrolments between 2011 and 2013, from 6,500 to over 25,000. They received an estimated $38 million in public subsidies, which generated an estimated $8 million in profits. Vocation has expanded aggressively, and they listed on the stock exchange in November 2013. They were placed in a trading halt in September 2014 pending a government review of their funding. Despite trying to assure investors that the review would be immaterial, ultimately the government forfeited almost $20 million in funding due to, and I quote, over-reliance on third-party student referrals, enrolling students in courses inappropriate to their needs, and delivering a low-quality training experience. The stock price plummeted, and the company may face an investor class action for failing to disclose these risks adequately. But what I found interesting is that in undertaking this analysis, that the disclosure of such information was only forthcoming upon the demands of investors and the ASX, but not to students and not to the VET regulator more generally. It was virtually impossible for us to find information on unlisted providers, and the provider audits generally lack detail and are out of date. And just quickly, the second publicly listed provider here is Ashley Services Group. Ashley also operates a portfolio of brands across different industries, and one of their main strategies, as shown in their own diagram here, is to cross-sell. They operate training, labour hire and employee recruitment arms using large corporate relationships to place, train and recruit students and employees across their three business divisions. Since the expansion of contestable funding in Victoria, their training division has overtaken the others as the main growth driver. In 2013, they had over 12,000 students, over half of them in Victoria, and we estimated that Ashley received about $17 million in public subsidies, generating around $6 million in profits. These business models have led to very strong and growing profit margins at these large providers. The data in this table here shows the profit margins for 4 publicly listed providers. The first 3 are Australian, and the fourth, Intuary, is Kiwi, where similar funding models have been in place for a longer period. The data shows that on average, profit margins have risen from 29% to 35% in 2013. These margins are well in excess of those in comparable industries such as childcare or transport, where profits are around 10 to 15%. The data shows that on average, every dollar of public subsidy revenue is generating around 30 cents in profits. Overall, our analysis showed that from the $800 million in Victorian subsidies that were paid out, almost $280 million in profits went to the providers and their owners, an outcome which has not been openly discussed at all. With these practices and business models in place, it's not to wonder that there are some severe concerns around the quality of training delivery. A range of these have been flagged in earlier reports, and our analysis found that the current regulatory framework has little hope of improving things. While ASCO is charged with registering and monitoring providers, their audits take place on average once every 5 years, and almost 80% of providers did not comply with provider standards at their initial audit. The regulator has few enforcement powers, and they do not audit an enterprise as a whole, but rather they audit the individual training brands, and they have virtually no information on subcontractors. The Department of Industry last year concluded that there is insufficient information about individual RTOs and their performance for governments to effectively target funding, for learners to select RTOs and keep track of training, and for businesses to select training options that best meet their needs. In light of these findings, the research concluded that it's virtually impossible for ASCO to regulate the sector for 2 important reasons. The first is that education is an experience good. It's not like going out to buy a television. Students cannot evaluate its quality until after their studies are complete. And unlike universities, the market is crowded with thousands of providers who often change names and ownership, so the judgment is even harder to make. The second reason is that for-profit providers use business models which are growing more complex and will always be a step ahead of the regulator. The regulator does not have the resources or the authority, as with schools and universities, to regulate businesses whose principal purpose is not vocational education. These two facts have meant that the objectives behind the shift to contestable funding have not been met. In particular, the assumption that opening VET to provider competition would improve affordability, quality, and transparency has led to quite the opposite. It is more difficult now for students, businesses, and regulators to make decisions, and now with the expansion of VET fee help and unregulated fees, students may enter into loans that they have no hope of repaying. And in return for this greater uncertainty and poorer quality of training delivery, vast sums of public money have been spent, and significant private returns have been generated for the owners and directors of these providers. And TAFE continues to bear the obligation of providing higher cost qualifications and servicing regional areas and disadvantaged student groups. TAFE cannot simply choose to provide what is profitable. In order to support TAFE's role as the custodian of high-quality vocational education and to ensure its sustainability into the future, we made a number of recommendations. The first is that educational inputs be directly regulated at the point of delivery. This is needed to overcome the lack of transparency over who is delivering what. This would include a minimum number of hours of delivery, as well as inputs including curriculum content, teaching and assessment practices. And it would be a big step towards raising confidence in the system of VET qualifications. The second is that contestable funding should be capped and the rest of VET funding quarantined for TAFE. This is necessary to ensure a sustainable TAFE sector able to deliver high-quality courses in unprofitable but important areas. It is also needed because contestable funding has not and cannot deliver on promises attached to the illusion of a competitive market for education. Our third recommendation is for a ban on subcontracting arrangements with unregistered and unregulated third parties. Through the course of our research, we found that there were many unregistered parties involved in course content, compliance, teaching, marketing, yet there's a complete void of information on the extent of these activities, and there's no way for ASCA to access this. And finally, we recommended that within the current framework that stronger provider standards be developed, at least so that the regulator can audit the enterprise as a whole and not the individual training brands underneath them. We think that these recommendations and the alarming analysis behind them are essential for rebuilding confidence in vocational education and the system of qualifications. It's frightening to think that the unscrupulous practices of some providers at the expense of taxpayers could erode such an important pillar in our education system. I thank you for your time today and hope that you'll join Damien and I in the workshop later this afternoon.